Yes, you're good now.
Awesome. Very good. Thank you so much. Obviously, technology is not very good. I'm really good at talking to people about real estate and multifamily, but not so good about my technological, though I'm getting better and better every day. So again, this is our Wednesday webinar. We try to do topics that we think are going to be interesting to people that are involved in it. I also want to encourage everybody at different times. I'm going to ask you to put in the chat if you think we've missed something you want to talk about. We will not take questions during the presentation, but there'll be plenty of time at the end of the presentation. So today, and I'm joined with Brad and Mike, and then Jasmine's always here helping us out. And there's lots of folks from the Massive Capital team. So we'll tell a little bit about everybody. So the next one is the disclaimer. We actually shortened disclaimer, but so you still don't have enough time to read it though. But basically we're doing a presentation. We are not selling or soliciting anything tonight. We are not accountants, lawyers, any of those smart people. And that's that. So tonight we're going to talk a little bit about who's Massive Capital. Why is multifamily still a smart investment? Our experiences of what we're learning. We're going to do Q&A. And then always hang around and answer any questions, even if they're off topic at the end of this presentation. So this is a Massive Capital here. So on the left, you have the three principles of Massive Capital, Sanjay, Shrar, and Mike. And then on the top, you have myself, Jasmine, Maria, and Candice. We're part of the investor relations team. There's Asket, who does our marketing. Brad, who's here tonight, he's actually our acquisitions manager. Ramesh, he works also investor relations and acquisitions. Bhaskar does underwriting. Jen is our asset manager. We have Angela, who is our chief of staff. Jonathan, our legal counsel. And then Senate heads up our education program. And we're always excited to see a lot of our students join these calls. So one of the things about we went too fast there. So one of the things about Massive Capital is we try to leverage all of the different aspects. So I always call on Mike to describe his favorite slide here, because he does a way better job than me.
I thought you were actually going through it
I was
today,
thinking of
Trevor.
it, and then I just saw you going, I can do it better than Trevor.
No, I can't. And this is, but it's just really, simple piece of way of looking at the value chain of real estate and where we fit, and then how we bring partners along. So starts with land, and every piece of real estate sits, or at least in my world, sits on land. I know there's some virtual worlds of real estate, I guess, out there. So for me, it's land packages, and then it moves into the land development and building development, meaning, okay, I'm going to build something on the land. For these two areas, we partner with developers that are that we've sorted with, looked at, checked them out and vetted them. And so we work with a couple credible developers on a couple deals. Georgetown is one of them, and near Austin, and the other one is X-Space we're currently doing and partnering with X-Space. And then we work together to go through this process of the land development and building out the properties. And then if we keep the property, then we'll operate it. And then, Massive Capital is great at on our own, at finding deals, mostly, value add type opportunities. And the value add then is where the renovation comes in. So we buy a deal, acquire it, renovate it, increase the rents, and build the value up of the deal over that. So that is the other piece. So after it's been built, we operate. And then if we go and buy, we put in CapEx and we increase the value of value add type opportunity and make money there. And then really the last, we don't do a lot of redevelopment. You think about something like turning an office into apartments, for example. And there are people out there that do a lot of that. We're not doing that at this point in our journey. Thank you, Trevor.
Yeah, my pleasure. So in 22, Massive Capital closed about $106 million in assets. So you can see they closed 7 assets. This year, we're on 5 assets. So we've already closed on 2 deals. And then we're working on X-Space that we'll talk a little bit about later, our value add in Denver, and our value add in Georgia. We'll just briefly mention it because it's a 506B, so you can only invest in it if we have an existing relationship with you. These here on the map are areas that we're targeting, so we're still looking at Tampa and Phoenix. We have done a lot of deals, and a lot of these deals, as Mike mentioned, we have local partners. So we're obviously very heavy in the Texas market, but we have local partners in all of the other markets that we do partner with. So today we're going to talk about why is multifamily still a smart investment? And we're going to keep this fairly high level, but then we'll dig in deeper based on what your questions are. Okay, so multifamily outperforms other types of commercial real estate simply because it serves a basic human need. People need somewhere to live. So if you think back from the earliest of time, the cavemen lived where? Caves. Right? They probably didn't pay rent. They may have had to pay rent. And eventually somebody probably took over the caves and made some sort of cave association and started charging people rent. But from the very beginning of time, we have needed a place to live and sleep and be at. With the housing prices increasing, more and more renting is the only option for people. So obviously with the interest rates going up, which we'll talk a little bit about later, but just the appreciation of real estate, it has become unattainable for many people in the workforce housing area to make a decision to be able to say, I can afford to buy a home. The combination of the down payment and the monthly payments and all the things that they need to be able to do, it is unachievable for them. Now, the pandemic sped this last one up. It always existed, but it got sped up a lot more. And it existed starting because people changed a little bit, right? I'm an older guy, you know, and we buy a home, we have a family, we, you know, keep a job, we do different things. And so we look at, you know, a little bit more consistency. Today, people are far more nomadic, and COVID made people put nomadicness or whatever, how do you say the plural of nomadicness? But it got amplified, right? Because you could live anywhere you wanted to live. So you could make decisions, okay, well, I'm going to go here or I'm going to go there. And you may not always want to move to another city and buy a house. Therefore, living in an apartment still made a lot of sense. And some of the people are fleeing expensive markets, coming to less expensive markets, but they still are unable to afford that market or make a decision just for the flexibility of their life. They don't want to be locked down with home ownership. So that's happening more and more, which is a phenomenon, right? The American dream was always to own your own home and do different things. So multifamily has typically set itself apart from other asset classes through all economic cycles, but it has also been relatively safe during inflationary times. Again, some of the things that we talked about before, some of the things that we were talking about, multifamily has been very safe. We all know that certain asset classes got really killed during different times. About the only time that the housing market was, you know, the 2008 crash. But to be honest, most commercial multifamily real estate came out of that pretty well. They all managed to stay going and doing. So multifamily has been fairly recession resistant because of its need, right? It's not like retail, where retail took a big beating. Yes, it's coming back. It's being repurposed. It's being imagined. Office took a big beating. Yes, it's coming back and it's being remanaged, but there's all different things that are different about it. Multifamily has kind of, like I said, it's been there from the caves. So it's been there for a long time. The next one, multifamily investing has an incredible array of benefits, including cash flow, the ability to finance properties with limited amount down and money, and incredible tax benefits. So if you look at doing other types of commercial real estate, it is not as easy. So for example, on X space, we'll talk about that a little bit later. Those are personally guaranteed bank loans, development loans. They're much harder to get. You look at doing retail, office, some of those other things, they're all require a different type of debt. But our debt market is really set up to benefit multifamily because the government wants us to build multifamily. They want us to build places for people to live. And multifamily, and I'm using that as a broad statement, right? It still could be build to rent, traditional apartment buildings. There's lots of ways that, I'm using a big blanket. And it also has incredible tax benefits that are not always existing in other types of asset classes. And again, the reason for it was the government has said, we need housing. We need things to go. So we're going to incentivize people to be able to do this. And this is going to give them extra benefits. So it's kind of like your cake with your cake and you can eat it too, right? With ice cream on the top. And then multifamily tends to appreciate over time because it's scarce. It takes a while for people to build new units for demand to catch up. Most cities are in a deficit in terms of demand, and there are some that are catching up. There's no doubt about it, but it has those features. So what's changed in the last year? All right, 3 big ones. And if I missed a big one, I would like you to pop it into the chat, and we're going to bring Brad in a little bit to talk about some of these things. But the biggest change is interest rates, right? Interest rates have changed everything to do with all forms of commercial real estate and even multifamily, right? If you think about it, I've been around long enough to know that, I've seen higher interest rates even than we have now in my lifetime. But on average, we were seeing interest rates in the 4, 5, 6 range. And then they went down to this crazy 2, 3, 4 range, right? Which was unheard of. And then never in the history of mankind has it gone up as many times as it has in a row. I mean, it's like on a skyrocket. And it leveled off a little bit. We all know in the last one that it leveled off and they didn't raise it. They still left it that they may raise it. But this has put a huge amount of pressure on people that weren't prepared and or tried to buy during that period. Obviously, another thing that's happened is there's been a large increase in insurance costs. Certain markets have really gotten worse. So for example, if you're trying to do an apartment complex in Houston market, you were probably buying apartment insurance anywhere from $500 to $750 a unit. And now you're lucky to get it for $1,700 a unit. And then again, a lot of municipalities have been chasing property taxes, and they've been catching a lot of people off guard, and they've had to be able to do that. They just have not prepared for the property taxes to go up as quickly as they have. So if I missed anything big, please put it in the chat. You guys got to call me out. And again, I didn't want to do a big deep dive on any one topic. And we're going to talk a little bit here. I'm going to bring Brad into this discussion a little bit more, but because he does all of our underwriting, and it's something that you really need to understand, and kind of pick 4 things that you really need to watch out for. So Brad, I'd go ahead and hop in here.
Yeah, sure. Let's go back to the last slide real quick.
Yeah.
So I want to touch on that. So when we look at these 3 factors, they're definitely true. I think everybody knows that we've had increase in rates, increase in insurance costs, increase in property taxes. So most of us would say, well, that's a bad thing, right? That's going to make multifamily harder to invest in, less profitable. But it's actually the opposite, because what happens when the interest rates increase is the cap rates follow interest rates. So I don't want to get too deep. As an underwriter, it's easy for me to get too technical, but everything we do is based on cap rates, based on a capitalization model, and that's how our pricing is determined. It's a little different than single family. So when interest rates go up, cap rates follow it. And when cap rates get higher, prices actually get lower. And then when we have these other 2 things, which are increased costs, that actually pushes our NOI down, which also makes the cap rate go a little bit higher. So the point is that these actually have an effect on lowering the price of multifamily. And if we're buying at a cap rate right now of say 5.5%, then as the interest rates stabilize and cap rates stabilize and begin to compress again, then where we buy at now, it's like we're buying low and we're going to sell high. So now is actually a really good time to buy versus in 2021, properties were trading around a 3 cap. And so what that means is that the prices were way higher. So right now, if we buy at a 5.5 and the market stabilizes, which we expect it to do, we don't know exactly when, then what's going to happen is we bought low, and when we get ready to sell, our projected profits will likely be possibly even higher than we projected. So that's a really positive thing. Let's go ahead and go to the next slide real quick. So a couple of things that we do look out for, like as underwriters, we always watch for these things. Right now, everything we're doing is a fixed rate debt. So a lot of the people that did get in trouble when they bought at a 3% cap rate in 2021 or 2022, now their rates are adjusting. Back then the interest rates were also really low. That's why the cap rates were low. Interest rates were 2.8, cap rates were 3.0, 2.8. So now that those have adjusted and they have adjustable rates, a lot of those people's interest rates are going up from 3% to 4.5, 5.5, 6%. And that basically eats their cash flow to where they have no cash flow left. And we're seeing a lot of operators that are in trouble based on that alone. So one of the things that we're doing now is we always do a fixed rate on everything we buy. The second thing that got people in trouble was a high loan to value. So let's say you're buying a $20 million building and you're able to get, when the rates were low, the lending parameters were less stiff, I guess you could say, and people were able to get higher loan to values. So they were getting 80, maybe 90% loan to value. And as they get into trouble, it's a lot harder to recapitalize that. So now when we're buying at about 70% loan to value, which is much safer. So those are two reasons why it's even safer right now than normal. Little or no cash reserves. Obviously, we do have to have, based on the lender, quite a bit of cash reserves. But more importantly than that, we want to make sure we have cash flow so that we know that the property will cash flow, that we will have future reserves, 6 months minimum in the bank in case something tragic happens or something catastrophic happens, we can still cover that. And inexperienced or underfunded or overstretched syndication teams. So when the market was going crazy, we did have a lot of people that came in that were brand new, that were, able to raise money easily. They were able to get lending easily. And then they didn't have a lot of experience with asset management. So that's why it's important to go with a team that has a lot of experience. Massive has a lot of experience, even prior to being partners. The partners that we have, their experience goes back, some of them over 20 years. So super important to vet the team that you're investing with. That's all I got, Trevor, if you want.
Anybody in the chat think we missed anything big here? Am I a genius and I got it all? I hope not. I don't know if I'm a genius yet. All right. So
no, but whatever you missed, Brad covered. So you guys got it locked up.
That's why I invited us. I knew. So are there going to be deals that are in trouble? Yes, no. I believe the answer is yes. There will be some, right? There will be some deals that may do cash calls. There may be some deals that take longer to stabilize. I went to a conference and a big phrase that came in, and they talked about survive to 25. Whether that's true or not, but that, if you can do it, you can make a big one. But it's going to take a little longer sometimes to stabilize, especially if you don't have fixed debt and you have expiring cap rates. You have all those different things, all the things that we talked about on the earlier slide make it, if you've really stretched all of your parameters and, nobody ever calls you up and says, man, I did like crazy liberal underwriting, you should invest in my deal, right? Everybody says we've done conservative underwriting, but you really need to dig into it and to make sure. So it could take a little bit more time for something to stabilize. And then are there going to be some deals? Yes, clearly. And we spoke about it a little bit before. Yeah, we have a comment in here. The market was flooded by lazy operators, didn't do their due diligence. Now they're over leveraged. Yeah, and it makes it really, really tough. So we actually believe that this will be a buying opportunity. Now, again, if you're the one who's in a deal that's struggling, that's hard, right? And there are risks investing in real estate. But again, we still believe that the fundamentals of multifamily are strong, and we'll have open discussion after this presentation. where you can challenge us, ask questions, or do whatever. But you've got to be sure that, you know, you want to make sure that you're investing in something that's safe. So what do? Okay, you increase your due diligence, right? You want to make sure that you're really looking at the deals. Again, all of the increases, rapid rent increases, lowering cap rates made some bad deals or average deals perform well. That's gone, right? Those things are gone. And then you stay with people you know, like, and trust. This is not necessarily the time to find new friends to give your money to. You want to make sure that you talk to people, or at least you talk to other people that have invested in it. And the number one most important thing not to do is put your money under your mattress. We are in a time where your money, every moment it's not deployed with the hope of making money, is hopelessly going backwards, right? You're going backwards. So what do we mean when we talk about a stretched syndication team? Do you want to talk a little bit about that, Brad? And I got some ideas as well.
Yeah, so I would call that just inexperienced. You know, if they're trying to do too much, or they're doing bigger projects than they could. The similar thing happened in 2008 in the single family realm when the banks were allowing everybody to buy a house. It's kind of similar. It's like what Warren Buffett says. He goes the opposite direction of where everybody's going. That's why now is a great time to buy. Now is a great time to invest, because everybody else is afraid of it. So what we're looking at is people that jumped into the market because it was hot. People were making money. People jumped in. The lenders were more lenient. It was easier to get things done. It was easier to raise money, so that you know, that's the stretch syndicator. They're able to raise a bunch of money. They look like a hero in 2021 because they're on their first raise. They're able to, you know, bring in $1 million each or whatever it is or more. So that's not common. That's not the way the market normally is. It's not the way the market is now. So it was overinflating their egos and overinflating what they could actually do. And now the market has caught up, and some of that stuff's being exposed.
Yeah, and we've talked about increasing your due diligence too. And earlier on, if you remember when we started presenting again, and this isn't why we're wonderful. Again, we think we're wonderful, but you have to decide on that. But we make sure we have partners in markets that we're putting real estate in. You know, so many of the people that join the syndication game, we're told you buy a property, you hire a property management company, and you go sit on a beach and watch the money roll in. And that does not happen. This is a business that requires people that have active business acumen, have done these types of things before, understands what they're doing, understands the markets that they're in. Are there lots of other markets that we might consider that we want to be in? Absolutely. But until we find and do our own due diligence on a local partner, that's very important. So all of those things, it just becomes a little more important, right? You need to ask a little more questions, and you need to watch a few deals go by, do the different things. So are there operators in trouble? Yes, but the fundamentals of multifamily are still strong. We believe that. And again, we're going to open this up in a few minutes to talking and open dialogue and question and answer. But we got to do shameless plugs at least, right? So we just happen to have a multifamily that you could invest in if you're an accredited investor. We're not going to talk a lot about it right now, but it's in the Denver market, a great market. We do have a local partner. This is our second deal in the market. So it's not like, and this asset is like a mile away from the other asset. So we have a lot of experience in that marketplace. If you're looking for something a little unique, I know we're talking about multifamily. Mike mentioned it earlier, some of our partners, but we are building this pretty cool development project. And the nice thing about it is it's a quicker payout at 2.5 years. And so if you wanted to get your money working and then have it come back quicker so you can redeploy it on something else, then you're able to do that. So you can reach out to anyone in Massive Capital about these. Next week, because it is July the 5th, we didn't want to do a big topic. So we're going to do a happy hour networking. And guess what we're going to talk about? Financial freedom, independence, financial independence, actually is what we should have said. But we're going to talk a lot about that. Now, if you're interested at all in investing, we've got this QR code you can scan here. We've also been popping it into the chat, but this is how you can reach through and get access to our investors, get access to our team. And I'm going to stop sharing so I can see you all. It's always, that's the only thing I don't like about sharing. I can't see you guys. I don't know if everybody fell asleep. Everybody's like excited. You guys still awake? Come on, let me know if you're still awake. Okay, we're still awake. Awesome. So what did we miss? Feel free to unmute yourself. What would you still like to know? Because again, we tried to keep this high level, right? We didn't want to get this. This wasn't an which by the way, Brad, you need to put the link in. Brad does an underwriting class every Thursday. And so we'll put that link in the chat. It's a really good one if you want to understand the fundamentals of underwriting. We have a lot of different things that happen.
Yeah, so we actually do a little bit of different topics every week. We've done underwriting the last 2 weeks. This week, we're talking about where to find deals in this market. And Jennifer actually just put the link in there. It's tomorrow at 7 o'clock Central, but you're welcome to join us. We're going to go over what Massive is looking for, what Massive is buying, where we find it, how to vet deals, and just basically where to find deals.
How many deals have we underwritten this year so far?
We have underwritten $2.5 billion in like the last 14 months. I think that's somewhere around, I would have to look at the number. It's probably around 80 or 100, might even be more than that.
No, that was 200 last time we had a number, so it's got to be close to 250 now.
Yeah, I just know the 2.5 billion.
Yeah. We look at a lot of deals.
305, sorry.
305.
Yep.
We look at a lot of deals, a lot of markets, a lot of different asset classes. And again, when you're doing your due diligence, we make offer on probably what, 10% of those and get serious on a 10% of the 10%.
Yeah, I mean, it takes, you've got to look at, I mean, probably 50 deals to find one good one, really. I don't want to discourage people, but when you really start looking at stuff, that's why we use 2 different phases of underwriting. We use a napkin underwriting where we can quickly eliminate 95% of deals. And that really literally takes about 4 or 5 minutes. I can actually put a link in the chat of a YouTube video that I created so you guys can learn how to do that. And then at that point, we take it to a phase 2, which is when we model it and we really deep dive on it. And that takes a little bit more of an advanced underwriter. And out of those, even out of the ones we deep dive on, probably only 1 out of 20 or 30 of those goes. So it is a process, but that's also why it's so important to us. The reason it is that hard is because we want to protect our investors. We want to make sure that everything we do brings in the right internal rate of return and has the right cash flow. And we have quite a few boxes that we have to check to make something move forward in order to write an LOI and in order to close. And if those boxes don't check, we don't buy it. So we do go through a lot of deals.
Somebody's got to have a question for me. I'm going to start calling on people. Everybody turns their cameras off when I say that.
Yeah, and you guys can talk about anything.
I think Candace was excited that her picture got added to the slide today. Oops, she disappeared. See, she turned her camera off. Go ahead. Sorry, McGinnis. Oh, yes. Sorry. Go ahead, Melvin.
Hi. Sorry. I was just going to ask the link that was just put in the chat. So that's for the class tomorrow, where it looked like signing up for the investor portal.
Okay, I don't think the new link's in there yet.
Okay, all right.
For tomorrow.
Jennifer can repost the class tomorrow link real quick. She probably just did.
Trevor, you've been so consistent with your passion about multifamily. I'm curious to know, when did you fall in love with this asset class and why?
So it was really interesting. So for a long time, I knew I needed to get involved in real estate, and I didn't. I was afraid of toilets, attendants, and trash, and I've made a lot of videos about my journey. And then then I went to the excuse, well, I've got no time, no money, just like a lot of people do. And I was on I call it the rat race, right? On the Monopoly board, going around, collecting my $200 at go. And then I did have a fairly good win with my job. Our company got bought out by private equity and I got some money. And then I'd already read Rich Dad Poor Dad like 20 years ago. So I knew the concept of it, but all the pieces didn't line up. And I went to a couple of weekend webinars, and then I went to one with a group, and Mike and Sanjay and myself are all part of this real estate group. And I learned about syndication. And it was like my thick head, a light bulb came on. And I started to learn about it. Then I went to some training on asset management. And I heard people saying, we live in an area where a lot of children don't speak English and get left behind in school. And we have a school across the street, and we started an English as a second language class for the students to come after school and be able to go to the clubhouse, and we provide them juice box. And it just started touching me. And then one other person gave their residents turkeys or hams at Thanksgiving. I don't know what the vegans do, so sorry about vegans, but and then the same one with the backpack, with the kids going back to school. One of the places gave the children backpacks and got the list and got vendors to donate and gave and it just started to touch me that, hold on a minute. First of all, I missed this whole thing about syndication, giving your money to professionals that know what they're doing, that have a team, combine it with other investors and bank debt. They're going to be responsible for everything, and I'm not going to be responsible for everything, but we're also going to make the world a better place. And I just started being absorbed by this. And then as I started thinking about my life and how long I went around the Monopoly board and just collected and didn't do anything about it, and I just became a mission of mine that, you don't have to invest with me or Massive or anyone. You just need to buy real estate now, right? So I talk, buy real estate and wait. Don't wait to buy real estate. And until you make money while you sleep, you will work till you die. If that's all you remember tonight, I served my purpose tonight. And I just became, I hope my passion comes through, but it's just, and then of course, joining Massive is like pouring gasoline on a crazy Canadian little boy, because there's been so much more opportunity to touch people. And it's just, I'm just passionate about it. And, where can you make the world a better place and make money and do what the government wants and get the tax breaks? I mean, there's not a lot of things you can do. And while I like other things, multifamily is still my sweet spot, because people need it. So Rochelle's one of my favorite people too, by the way.
You tell that to everybody, but I like you too, Trevor. Thank you so much for this presentation. I always tell everybody, who invest with me or our partners, go and vet your the sponsor team, because you want to know who has their money and where you can find them, right? And so I invited people to come to this webinar and just learn and meet everybody on the team. So thank you so much for putting this together. Yeah.
Rochelle upped me, by the way. I want to do 1,000 people financially free, and she put 100. I think just up me.
That's right. And it's actually, so I've added a few people to that count. And so now it's only 99,995 nurses and healthcare professionals. So yeah, so to talk about the cap rates, my husband and I, Tariq and I, just walked a property here in the Bay Area at a 5.3 cap, and it's an 18 unit. And I think there's an opportunity here, even in states like ours, a blue state, there's opportunities popping left and right. So we're actually curious, we've always historically, I think operators are scared of blue states, but I think there's something brewing. And so we're going to take a look at this and maybe submit it to Brad to take a look at criticize it.
5.3 in San Francisco is intriguing. I'll say that. I'll also say that we could see, the thing about blue states is we have to remember that the reason they became blue is generally because they were awesome geography first. So a lot of people moved there when then there was a lot of people, then the politics come in and they have to regulate. And so they're always at leading edge. So that's kind of why they're blue. But underneath all that is the fact that they're awesome places, generally speaking, geographically. So those places like San Francisco, Los Angeles, San Diego, you know, they never ever will lose too much value. And as they go through a little bit of a drop from some of the things that are happening now, you're going to see them surge back like they always do. So
Yeah. So I'm glad that piqued your curiosity, because this is coming to you, Brad.
okay, you know how to send it, right?
Red IQ, I was going to ask, can somebody post that link again?
Yeah, I'll post it right now.
Awesome, thank you. And so my question, I actually have a question after all that. So what's the general consensus on the interest rate, you know, coming with the coming presidential elections? Are we seeing or hoping, are we hopeful that the interest rates are actually going to come down? And if not, I mean, I'm pretty confident on how you guys underwrite, so I'm not even worried about that. But you know, we have some investments that we're hoping to be able to refinance. But I'm just wondering what you guys' thoughts are.
Yeah, so
My
we
crystal
actually,
ball is broken, so I'll let Brad or Mike answer.
when did it break, man? I thought that thing was working good. Okay, so Mike, correct me if I'm wrong. I know Shariah watches this real close for our team, but I do believe that the probability, there's actually groups out there that do the probabilities on what the raises will be each time the Feds meet. I believe we have a 75% probability of one more raise, and then we're going to start to see it either stay flat or maybe even some reductions after that. So that's the latest I have heard. Does that sound right, Mike?
Yeah, that's, I mean, that's the numbers that generally we're hearing. And percentage wise of one more bump, small one probably, stable, and then or down.
After, yeah.
But you know, those predictions, if you look back when this started the ebb up, I don't think anybody saw how fast that this was ever really going to go either. So, you know, that is you know, as far as following trends and what the predictions are, that is what we see and kind of our expectations right now. So, you know, we even will, you know, look at doing some deals right now on, you know, on flex, you know, floating debt or bridge debt as it's called, just because we expect, as talked, that it's at the peak, and once you get it stabilized, you're going to be in the money to be able to, once you can get it, you know, stabilized and the cash flowing, get your debt service ratio down, get your vacancies down, occupancy up above 90, then you can go into a long-term debt and be in the money. So that's, you know, one good way of, you know, if you can make a deal work at bridge debt, you get it, you know, that's one way that we're looking at stuff right now.
Yeah, I would like to add to that a little bit. So people say, well, why would you know, most people are like, let's take over a 3.5 existing loan, you know, and we would actually rather do a 10% bridge debt. So let me tell you why. If we can do a 10% bridge debt, what does that do to a pricing? So in order for us to do that, it has to pencil out, right? So if our cost of money is 10%, that's going to expand the cap rate and reduce the price. So if we get that asset to pencil at a 10% bridge debt, by the time we stabilize that thing, we are going to be, you know, doing very well. I'll just say it that way, because once we stabilize it and refinance it, if we modeled it at 10% and now we're locked in at 5.5, we're in an excellent position. So that's why we would almost rather, you know, sometimes it's hard to find a deal that will pencil at a 10% bridge debt. But if you do find that deal and you can purchase it based on those parameters, then you are golden when you get ready to restructure it.
Yeah, I didn't think they do the rate increase before, so that's why I say my crystal ball was broken. When it started just to calm down a little bit, I thought, man, they're digging this big old hole, they're going to stop digging and pull their head out, and they didn't. So Any other questions?
I
Did
just have a
talk too
quick
fast?
comment.
We're done early. Go ahead, sorry.
Oh, I was gonna say, that's an interesting take on the bridge debt, because that has been the hot word for a moment, right? Like nobody touch an investment that has a bridge debt. But I'm curious as to how you guys underwrite. How high do you stress test the rates for a bridge debt like that?
Well, we would need to be able to restructure it at, 6.5% or 7%, most likely. It would depend on the asset, depend on the location, depend on how long the bridge debt term was, but probably around 6.5% or 7%.
But starting at 10% on the bridge
Yeah, I would start at 10.
right now, but we're not stress testing it until we decide we're going to go into an LOI and under contract. So we don't go through a lot of scenarios on how, if it went up to 12%, what does that do type of scenarios until we're into the next phase of the due diligence part.
Yeah, on the next space, it's capped at 10%, correct?
Yeah, that's right.
There.
Yeah.
And we're pretty close to it now because it's LIBOR plus 4 points, but it can't exceed it. So we know that going in, and again, our goal is to be out 2.5 years. It's longer term than that. So it's when people have been getting most bridge debt was 3 years and you were easily stabilized and refinanced. But if your interest rate all of a sudden went from 3.5 to 6.5, you're in big trouble because you can't refi. Any other questions? Doesn't have to be about this topic too. Be about anything. Wow, you guys are super quiet tonight. Is like everybody getting ready to take the weekend off? Anybody? So to give you an idea how boring I am, my goal is to stay awake late enough to see fireworks. Isn't that pretty pathetic?
We had ours, Trevor.
I
The
did
Ford family
a
put them
joke.
on Monday.
Somebody said, "What are you doing?" And I said I was going to stay awake for midnight on New Year's, and that was a joke. But I think I can stay awake for the fireworks.
So where are your primary areas you guys are looking to invest right now?
So we're doing Texas, Colorado, looking a lot in the Carolinas, right, Mike, in Tennessee.
Oh, yes. Yep. Georgia.
Y'all gonna come down to the Panhandle of Florida?
Yeah, absolutely.
Come on.
What
Yeah,
you
we've been
got,
looking at deals
Adam?
down there.
What you want?
Do you have a deal?
Oh man, I always got something working. I probably got something. We're doing a development here now, so that's kind of what I'm tied up in. I just got interest in the company, so I'm helping them scale. But yeah, we got like a little townhouse development going.
Nice.
Well, it's not kicked off. We may do it entitled. We may not. I don't know what the full play is. I've got a couple partners that are on that. So, but we got 4 acres outside of probably the hottest development in my area, which is a very small area. But I think we can do something like 54 doors on. DR Horton's interested, but they're always interested. So I don't know. We're talking to people to see what we can do.
Nice. Yeah. So that's pretty similar to the size of what we're doing in Georgetown near Austin, which was
Grant's
10.
been scooping up stuff in my area left and right, though. See 10X living everywhere.
Yep.
Yeah, we did 10 acres at Georgetown and we'll fit about 100 townhomes. Right now, we're looking to build them ourselves and do build to sell.
Build? Oh, build to sell. Okay, cool. Right. Y'all have any properties under construction right now or anything with construction loans converting to conventional, or I don't know, just a topic to throw out there. We got one in Tallahassee that's kind of going through some, we're gonna get it through, but it's got some issues.
We don't have anything, I mean, we're on the X space one, but we're at a different part of that. You know, we're bringing capital to the deal and X space is building it.
Okay, yeah. We're converting student housing to multifamily, and took a little longer, rates, yada yada. I threw a rate hike or rate insurance in there. Didn't know if y'all wanted to talk about that or whatever. We bought it. So glad we did.
Talk about it.
Well, truthfully, I didn't buy it. I just got a bill for it. So I was very unhappy when I got a bill for it. But then when I got my little investor sheet, I was very happy that we did it. So don't know the ins and outs. Y'all may know more than me, but basically we purchased a policy that capped our hike. It could only jump so much, but we were also under some construction loans and a couple other different deals.
Yeah, a lot of the
Y'all are
lenders
the
were actually
professionals.
forcing it. A lot of the lenders were actually forcing you to have that for a period. I think they've laid off that a little bit now, but as that was going up, they were forcing you to have that insurance. And I mean, I don't know what the costs were. They're 1-2%. They're pretty high. I mean,
Heavy.
you're talking 100,000, 200,
Heavy.
300,000. Yeah, it's
Heavy,
pretty.
yeah.
Yeah, they went up even higher than that. So the
Yeah, we got our property
The-
before all these rate hikes started jumping. I mean, this was like the tail end of the rainbow road, so to speak.
yeah. Yeah, rate caps can be, and there's a formula out there, and there's a few websites around rate caps, but they also can pay off as well. So right now, like, even, you know, we've looked at some properties that are 3%, actually. So it's, you know, you're like on a, you know, $20 million property, for example. I mean, you're seeing some rate caps that are, you know, 400,000 or 500,000. So it's, you know, because they're just trying to be sure they cover the reserve. But what happened was they also have to pay out. So like once you hit, so it's insurance that pays you back as well. So once you hit the cap, you actually start getting a return on the money that you on the insurance. So when it goes above a certain number, you actually get money back. So it doesn't just cap it, but you get a dividend back as well.
Yeah, I'm not sure how ours works, so I can't speak on that.
So yeah. And there's,
Awesome.
yeah.
So remember, next week, we're just doing networking, So bring your talkative voices. And we're gonna do some group net, and then we'll break you into small groups to connect and get to know people. Real estate is a team sport. So I guarantee you that there's somebody on this call that will be your partner.
Okay, I saw a Q&A question, Trevor. Can 1031 exchange be used to invest with you?
Yes, so you can definitely accept 1031 exchanges. You would do a thing that's called a TIC, which is a tenant in common. The secret is all the timing has to work out, right? So it's, you know, because you have a ticking clock, you have to make sure that the deal closes. We've done several on some of our syndication deals. And it just, the timing has to work out for everybody. Normally you look, you know, it's not cheap necessarily to do it in extra paperwork. So, you know, you usually look at least $500,000 and up to be able to come in. That has to work for everybody. But it's definitely a great way to, you know, take some money and defer some taxes.
Yeah, and you know, let us know if you also, if you go to the website, the one that's the Massive Capital Access, there's a few little tabs in there. One is to schedule some time. So if you want to go there, schedule a meeting with any of our investor relation team, and then they can talk to you about that as well, and we can, follow up. So a lot of it depends, like Trevor said, timing of our deal, timing of your deal, the amount of the 1031. So just need to work through those different things. And the same thing in that access folder is also some of the stuff that, like Brad's thing as far as where to submit your deals is in there. If you're interested in any of the coaching programs, there's a link in there to follow up with the coaching programs and everything else. So just take a look into that little site, and there's quite a bit. There's also a few freebies in there, an IRA ebook, some other freebies in there as well.
And I know Tracy's gonna have her holiday on the 1st. So I celebrate Canada Day and Independence Day, so. 'Cause I'm from Canada. Tracy, I know Tracy's from Calgary.
You're not coming back to Canada?
I'm not coming back, but the best thing is Canadian Thanksgiving and US Thanksgiving, because I love turkey. So I get to eat it in October and November. Any other questions? Things you want to talk about?
Why aren't you going back to Canada?
Too much to do. I was there a couple of months ago. My daughter got married, so. Like to go back up this fall. Fall is beautiful up there. Texas, we don't get fall.
How is the weather look like in Texas during the fall season?
Yeah, we go from brown to brown.
Round and round?
Because it starts out green and then it all cooks. And then when the fall comes, you get a little bit of color, but nothing like the north.
I think the fall season in Alberta, the weather scenery is very beautiful so far. If you go
Yeah.
through the Bank and the Jasper.
Awesome. Well, I hope everybody has a great holiday and enjoy your weekend. And hopefully we'll see you on Wednesday, the 5th. 6 o'clock, we're going to do networking. So come to be able to make some new friends.
I do got one quick question
Sure.
on things that have assumable debt. What would you look for in that before it's worth your time? What I guess the length of time that the loan matures and whatnot, obviously.
Yeah, so the first thing to think about is exactly what you said. The reason it's assumable generally, or sometimes it has to be assumed, it's because they have yield maintenance that's due, which is basically a fancy way to say a prepayment penalty. So a lot of times you'll come in and they'll have 7 years left on that. So if you have a 5-year plan and you're planning on selling into year 5, you have to figure in 2 years of yield maintenance, which is, there's a couple ways to calculate that, but basically it's going to be 2%. So your exit costs go up by 2%, right? So you have to calculate when you're going to sell, how much it's going to cost you to sell. Also, you can look at supplemental. Some of those lenders will allow you to add to that loan. So let's say you have a $10 million loan, you're buying a $17 million building. They may allow 3 million supplemental. So you want to ask about that. And then also when you're assuming the loan, you want to make sure you have a team such as Massive that has assumed Fannie Mae, Freddie Mac agency loans, because they are going to review the team pretty heavily. Other than that, I mean, that's the interest rates can be good. But again, if you have a lower interest rate, it's going to push down the cap rate and it's going to raise the price of the building. So it's not always quite as sexy as it looks.
Yeah.
I guess I have a theory on that.
Sure.
This kind of just my way of thinking is that if you can buy it while the debt is high, you're paying less for the equity. So when you can refinance, you're essentially going to be $1 or $2 or $3 million ahead, because you're going to have a whole lot more equity to pull from if and when rates do come down, I guess I should say.
Yeah, so that's one more thing that happens when you assume a loan is you have to raise more equity. Because generally speaking, you can go out and get 70, maybe even 80. I did see a quote for 80% the other day, loan to value. But if you come and take over a loan, that loan was 80% when they bought 3 or 4 years ago. So that price has gone up. And so now you're taking over a loan and you have to raise, instead of raising 30% equity, now you're raising 40 or 45%. And equity costs more than the agency loan does, right? So that increases your cost on the building as well. Or oftentimes that takes out the advantage that the lower interest rate gave you just because you have a higher cost of equity.
Makes sense.
Yeah, and our Cottonwood deal that we mentioned earlier in Denver, it's a loan assumption. And it worked really well because it didn't need a big CapEx on top of the what we needed. It gets to be a problem if you have a really big CapEx on top because you have to raise it all. And obviously investor money is always the most expensive money. So if you can't get a supplemental or you can't get, and then of course, how much interest only is left also plays into fact.
Yeah, that's a good point. And on smaller deals, it works better just because the capital raise is more manageable. The larger the deal is, the harder the capital raise gets. And sometimes you end up having to raise a lot just because it's an existing loan.
Okay, Brett, I had a question to ask you back. Under what circumstances, Massive Capital won't be interested to do the loan assumption?
Okay, say that one more time for me. I missed the first part.
I said, under what circumstances, Massive Capital won't be interested to do the loan assumption deal?
Under
So
what
what point?
circumstances?
Okay.
Yeah.
Yeah,
really
under
the
what
model-
circumstances would you guys not want to do a loan assumption deal?
Yeah, so kind of the things we talked about, but really the model is going to tell us, like we're going to put it in there and let's say it's a 60% loan to value. And that means we have to raise 40%. And then that means our cost of equity is higher. It's a bigger percentage of the capital stack. So the model kind of exposes that, right? So the model is going to tell us, because if we put in that deal and let's say it's a 3.9 assumption, and then we have to raise 40%, and we know what the whisper price is, but at everything, when everything's put in there, we're only getting a 13% IRR. We know that deal won't work, right? So the model is just going to expose when we can and when we can't. Does that answer your question?
So you still measure back to your IRR, your targeted IRR.
Yes.
to okay.
Yeah, so that's one thing that's really cool about Massive is we pretty much don't do anything that's under a 17 IRR. There are different markets that can handle a little bit less. There are markets where 15 is normal, but in most cases, like for example, Texas, you need to be above a 17. So that's kind of one of our main driving factors. I mean, we solve for the team, we solve for how much equity we need to raise, and then we solve for the IRR. Because if we try to bring a deal to market that has a 16 or a 15 or a 14 IRR, in today's environment, that's just incredibly hard to fundraise for.
And we've spent a lot of time looking at deals like the one we looked at not too long ago in San Antonio, and it was, everything worked out well other than it was had a big CapEx budget. And there was just no way in today's market that we could get it done and deliver what we want to deliver to our investors. At the end of the day, if you can't deliver a good return to your investors, the deal does not work. And if you push the numbers and try to cheat the numbers to make it work, that's a recipe for problems.
Yep. Sometimes people will, some stretch syndicators, if you will, may stretch the rents and try to achieve higher rents. And, the market's going to tell you, that's the thing about multifamily. The market speaks. I mean, it is what it is. If you try to go too high with your rents, you're just going to increase your vacancies. So it's really important. We really stress that we have to make sure we can justify our rent increases. And how do we do that? We actually go and look at the actual buildings that would be our comparables. So we act like we're a couple shopping for an apartment, and we say, okay, would you want to stay in our apartment or this apartment? And we look at the pool, we look at how nice it is, and we compare so we know exactly what the actual rents will be. And that's really important.
Exactly. Well, this was awesome. Thanks everybody for showing up, and we will see you next Wednesday night.
Thank
Take
you,
care.
guys. Awesome.
Thanks,
Appreciate it.
Thanks everybody. Have a good night. Remember,
night.
invite your friends.
Hey, yeah, thank y'all.
Thanks a lot. See y'all.